Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and any questions you might have. Also, where there are opportunities in the market, what to expect in the months of February in terms of equities, treasuries, and we'll go over some of the most recent trades, setups, and how I traded them. So for those of you who are new, welcome. If this is your first live event, do me a favor, tap in first. Always want to welcome new subscribers. Most of you are returning subscribers, welcome back. Really appreciate your time. This is my brief bio. My background is in technology. I work as a CTO of several publicly traded companies. Once I left the companies, I started Tradespoon over 10 years ago and managing my own money. So that's my background. Very passionate about financial engineering, quants, artificial intelligence. We have a team of financial engineers that are building new models to spot opportunities in the market. Disclosures are very important. Please read them. I'm going to go to specific trade ideas. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept them in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. All right. Before we get into trading plan, let's talk about market and what do we see. First, let's start with spiders, right? We're end of the January, right? We started February. Another green candlestick, right? All new all-time highs posted this week. We only had literally one red week in the beginning of January, a little pause, and then continuation of going higher. So that's spiders. The question is, where is the spiders going? How far can it go? Well, next round number is 500, right? And that's psychologically, 4,000, 5,000, that's what people are gravitating to. I've been starting using the Trader Hawk, right? We do have a relationship with Trader Hawk. I actually post this. So you can look at this VANA exposure, right? It's a dealer exposure, dealer flow. You can basically see where the support and resistance levels are, right? So you can look at, today's expiration and next week expiration, and you can actually see where the support and resistance levels are. What you're looking at this, basically the way you would think about it if you're not an option trader, but it's still important information. You look at where's the concentration of open interest for different strikes, and then you look at the fixed vol in that specific strike, right? How much implied volatility, right? So VANA is just sensitivity of delta as its relationship to implied volatility. That may or may not be important. What's important is just you do know that there's a lot of buyers and sellers, right? There are dealers on the other side, people who are buying and selling at these strike prices. You can see at 500. Big blue spike, right? We do have put skew. So at 500, there is a big concentration for the next week, right? Basically, what does it mean? A lot of people are concerned, bullish, right? And they at least, this what it tells you that most people don't think there's a lot of momentum outside of 500, at least in the next week or so, week or 2 weeks. On the downside, if we do have pullback, right? Then you can look at these strikes, the red strikes, right? The red, everything left of 490, that's puts, everything the right of the 490 are calls, right? So you have out of the money calls, out of the money puts, and then concentration in strikes. Even if you're not an option trader, I would still pay attention because these are your automatically support and resistance levels that you can kind of look at the traditional technical analysis. So you can see 488, right? So between now and next week, we're probably not going to drop. Let's see, the strike is where the lows were of this week, right? Somewhere between 484 and 486, where a lot of put concentration, right? Meaning people are buying puts that are hedged. So unless you have a big some kind of NYCB event, right, where there's a lot other regional banks go under, you probably, these positions are well defended. And then you can zoom out to the February expiration, February 16, and actually get a better picture, right? So this is a lot bigger concentration, right? VANA, that, open interest in these strikes is a lot bigger. If you now look at the monthly concentration, right, monthly expiry, and you can see that 504, big concentration 504, and this acts as the magnets, right? When you have a put skew, like on spiders, i.e., if you look at the equidistance, right? If you're trying to, if the market is at 490, right, and you look at the 500 call versus 480 put, right? On put skew, there is usually a little bit more premium on those 480 puts than there's premium on 500 calls, right? So there's a put skew. That means that institutions, dealer flows, basically reflect that large institution, pension funds, wealth management, they're hedging their positions at these specific strikes. You can see peaks, a lot of support at 470, right? 470, 450. So most likely market is going to have hard time breaking through 475, 470 level, right? And probably not going to get far away from the 500, 505 level, right? In the next, going into February expiration. So that's the dealer flow and looking at the open interest, right? Then looking at neural networks, right? So this is data using basically options data and implied volatility data, right? It basically says, show me all the buyers and sellers, right? The supply and demand and each of the strike prices and where are the picks. And at those picks, that think of them as just trenches, right? I always make this reference to World War I, right? Where there was a stalemate, right? Between one side and the other. Those spikes in open interest strikes, think of it as, again, these are trenches where bulls and bears are holding their positions, and you need some kind of catalyst to get them out of that place. If you look at our neural networks that we've developed using artificial intelligence, learning on price action of the data, if you zoom out to 6 months, model does see that potentially not in the months of February, but getting to 509, somewhere between 490 and 509 level. Not a lot of momentum outside of this 504, 510 level. So basically confirms what you see in implied volatility. On the downside, it sees 457, 465. The open interest implied volatility, the open interest of those strikes probably, you need some kind of a negative event, right? Maybe a February option expiration, right? Or VIX expiration, or maybe another regional banks, is going to have some balance sheet issues. That maybe can push it to 457, 465. Otherwise, just looking at the chart, you can see that 50-day moving average, right? Traditional technical analysis says 9 out of 10, 7 out of 10 times 50-day moving average is a good support. That's why you see a lot of open interest at these strikes, 470, and 477.5 or 475. A lot of activity in these zones because people, everybody follows technical analysis and they say, listen, 50-day moving average should hold. And any negative news, you have these big moves, movements to the downside. Okay, so we look at neural networks, right? Artificial intelligence. We look at the dealer flow, right, into months of February. So, what's the next step, right? Earnings are behind us, right? Most S&P 500 companies already announced earnings. We have final results from Meta, right, to the moon, up 21%. Apple slightly down 1. And then you have Amazon down 6%. Oh, sorry, up 6%. So you do have, strong earnings like Meta, Amazon, Microsoft. These are the strong earnings, and then maybe Apple, Tesla, and Google are, less. So the question is, who's going to be right, bulls or bears, right? Are we going to get to this 500, 505 level, the way the, we see the call concentration, right? Next move into February, right? So let's call it 505. 500 is very close, or could be there not by end of today, but by end of next week, we could be this. Right, so one way is 505, right? We're heading to 505, and we'll gravitate toward 505 by end of February. The other one is, there's a big puts concentration around 50-day moving average, which probably will be around 478, right? So maybe we, get to 505, but instead of gravitating to 55, all the good news, all the earnings are already out of the way. We know that it's probably higher for longer after the unemployment data, right? We still have a very strong employment, wages are growing. PMI data was better than expected. There's still some inflationary pressures where you could see the movements in interest rates today are, kind of elevator up, elevator down. You have these large volatility in the treasury market and the bond market. So treasury market and currency market. So we're gravitating toward 480, right? Kind of trading, one scenario 505 and greater, right? That's one scenario. Scenario number two is between 505 and 478. And then the third scenario, maybe another bank goes under, right? Over the weekend, people panic. And we're scenario number three. Right, so these rehearsal exercises are extremely important, right? Because you want it, what does this view tells you, right? People ask me, Vlad, this is all nice and wonderful, but where are we going? Well, it doesn't tell you where we're going per se, but it just tells you the distribution, right, of possible outcomes, right? And how are people positioning themselves, right? And then you can position yourself, you can be bullish, you can be bearish, or you can be market neutral, right? All three scenarios are totally fine, right? You can look at the macroeconomic data, you can look at, Meta earnings, Netflix earnings, and basically say, Nvidia earnings, and basically say, inflation is going lower, the trends are in the right place, Fed is going to cut rate, it doesn't matter if it's March or May. And we're heading to scenario number one, right? And you position yourself for scenario number one, right? Or you can say, well, regional banks are down, small caps are down, high beta stocks are down, you don't have a broad participation, so, I think it's scenario number two, right? And you position yourself to be market neutral, basically. Maybe you buy on the dips, right? And third scenario, you might say, listen, if NYCB Bank has issues with their balance sheet exposure to, treasuries, exposure to corporate real estate, how many other banks have, skeletons in their closet that, slowly will come out. So, all scenarios have validity, right? They all have certain probabilities. Nobody can tell you exactly, well, it's 100% scenario number one, 100% scenario number three. You look at these probabilities, you look at the odds, and you basically position your portfolio toward a specific scenario based on your beliefs, right? All right, so how many of you say one? We're heading to 505 and above, by end of February. How many of you say we're just going to be stuck in this range between 505 and 478? And how many of you say scenario three, we're going to test 50-day moving average and break through it? Martin, one, up and away. Joseph, two, down, two, Mark, two. Anybody, three? Nobody thinks there's another regional bank going under in the next 4 weeks? Andre, two. Okay, so majority of you said two, everybody said one. I'm gonna say three, right? I'm gonna be unpopular, right? I like to take unpopular approaches. Most likely it's gonna be two. Most likely it's gonna be two. But again, looking at this dealer flow, and one of the reasonings that I like, that I've been learning a lot, is that Why did I do this? 1 second. So I'll give you the reasoning, right? And the idea of these dealer flows is that it doesn't really matter what, whether, Powell is gonna lower interest rates in, March or in May, right? We can argue until we turn blue, whether if it's in March, then market is gonna go higher, but if it's May, it's gonna go lower. We don't know, right? This positioning, how the institutions are positioned, right? You don't have exposure to all the data, but options data is extremely important, right? Basically, the idea is that so let's look at volatility. Let's look at dealer exposure. Let's look at spiders. And let's look at, so biggest expiration is monthly, right? So you look at the February 16th, right? It's 55,000, right? The peaks at 55,000, right? And then March expiration, March 15th, is 75,000, right? So February is approaching expiration, almost half, a little bit less than half of the puts will expire, and short calls will expire, right? So long puts and short calls. So people are selling calls, they're buying puts. Close to half of the volume will get expired. And as you approach that expiration, as delta decreases, market makers have to be delta neutral, right? So any negative surprise, right now, when you have a negative surprise for New York, regional bank, everybody is entrenched. You have February defense and you have March puts and you have February puts and you're well defended. If half of the volume disappears as we're approaching close to February expiration, then the next couple of weeks until their new positions are established, you could have, some kind of issues, right? And, we have geopolitical risks, we have, now regional banks again in front news. We have China falling apart. Right now when China says a couple lenders are going under, everybody's well positioned, they have their puts and they're like, okay, so what, right? But if half of the puts are gone and China, another lender defaults, well, then that's where you're vulnerable, right? And that's when you can actually have steeper pullback. So I would be cautious, right? This doesn't mean that scenario 3 will occur, but I think this does have enough probability that one should be concerned and at least position yourself going into end of February. I would say either market neutral or maybe slightly bullish buys, but still have some kind of hedges in case market pull back, right? And volatility VIX rises. You want some kind of hedges, right? Some kind of hedges, especially as you can see that when it comes to bond market, it's extremely volatile, right? You have these, 5% up, 5% down. That's not normal behavior for the bond market, right? And dollar is making new highs, right? That's also not a good setup for a bullish scenario, right? So market neutral, I would say, my opinion is you should be market neutral. I'm personally actually slightly more bearish because I think scenario 3 can occur. And then, if you're bullish, I would still have at least one of the 4 positions to be bullish. At least one of the 4 positions to be bullish. So yield is important, dollar is important, right? Let's look at the weekly charts. Right? So obviously banks, right? So IWM, unable to break through this, it pierced through the uptrend. Make it a little bit more clear. So the peers broke through the uptrend and then tried to break above this overhead resistance 198, failed, and we're ending the week, towards the lows, right over this important support 191, which we faced before. ARK Innovation, pretty weak, right? ARK Innovation is pretty weak, unable to break through this. This is high beta stocks. and then regional banks, right? Regional banks are, big pullback again. Try to break through this downtrend, break above this downtrend, and obviously after NYCB you have a large pullback, which means this line has been, defended by, bears, and bears are now gonna continue push. We're, just need one more negative news and potentially there's a follow through. We'll see. I mean, if it's an isolated event and market reverses, then fine. But I would pay attention to small caps, regional banks, right? And obviously, the Nvidias of the world are continue to grind higher, right? Whether it's Nvidia or QQQ in general, we are posting new highs. Kind of vertical move, which also, at some point ends, right? At some point, you have elevator up, and then as acceleration is slowing down, you have elevator down. Okay. Any questions? Bob, welcome back. This month reliable will be revised downward after holiday season, calculating daily. Thank you, Kevin. Interest rate reversal higher. Any comments? So yeah, we talked about interest rates. Well, I mean, yesterday, right? Yesterday, interest rates dropped because well, prior, right? Because you can see that inflation is slowing down, right? And going into the, the Wednesday, right? Going into the Wednesday, all the macroeconomic data that shows that there is a disinflationary forces, right? And what was it? Employee Wednesday. So manufacturing data in contraction, but turn out to be better than expected, right? So people say, well, recession is probably not happening, right? Because ISM manufacturing got a little bit better. And then Thursday, and then we had the day before this employment cost index, which also went down, right? Also kind of a disinflationary forces, and market is extremely sensitive to this macroeconomic data, and you have a huge drop, right, in interest rates. And then Powell, spoke on Wednesday, right? Interest rates continue to drop. You turn on Bloomberg, they're basically saying, well, if they're not going to cut in March, all it means they're going to be more aggressive in the rate cuts going further, right? Because things are shaking, things are, you could see the distress in the system in terms of liquidity, right? Everybody's concerned about liquidity, capital requirements. One of the theory why the NYCB bank is in distress, because they acquired the assets from the First Republic. They got into this $100 billion on their balance sheet, and that's new capital requirements, right? Stricter, capital requirements, and this is the reason, for their, basically 50% drop. Okay, maybe. Or maybe it's because they have a lot of exposure to corporate real estate, and that corporate real estate, as it matures, right, you have to write it off, right? And you have big drop in your balance sheet, right? And that is, could have a domino effect. Today, big reversal because strong employment, right? Very strong employment, a lot more jobs got created, wages are going up. And what does it mean? That, not only, you might not cut in March, you might also not be able to cut in May, right? If you have these inflationary forces, right? So interest rate is up, dollar is making year-to-date new high. And that's the headwind for your bulls, right? Bulls are, you can see value stocks are negative today, right? So Nvidia cannot, this QQQ up 1%, because you had Meta hitting a home run and Amazon is hitting a home run. But Amazon and Meta is not going to carry market for too much longer, right? We're kind of using Bob's favorite indicator, MMFI, right? So you can definitely see that the stocks above 50-day moving average in 2024 has dropped significantly lower, right? I mean, hitting 200-day moving average, so it's a little bit overdone, but this does not look like your traditional bull market, right? Because most of the companies are actually going lower, right? It's just NVIDIA, Microsoft, and a few others are going higher. But majority of the stocks are significantly down. Bob, thank you. Kevin, Biden, yeah. All right, we're not going to talk about Biden. Kevin, thank you for your comments. VIX is stubbornly low. Yes, you can see the distress, but the animal spirits are alive, right? We talked about this call skew for AMD earnings, right? Huge volume, right? We've seen Google's no hedging in Google, no hedging in Meta. People were not buying puts, so there's still flows to push the market higher, right? And but on Valentine's Day you have your dual expiration. The VIX expires, right? So people are going to sell their, a lot of their positions in VIX, and then Friday you're going to have half of the put volume basically expire, right? And then there'll be new positioning, and then people are going to think about, well, higher, what's the chances of basically either something happening or of a recession, right? Right now they don't have to think about it because they are protected. They have puts at 470, 480 level. They don't care. But when half of those puts are gone, they will care, right? And especially dealers will care, right? And dealers want to be market neutral, right? They don't have an opinion on Biden, nor do they have opinion on, probabilities of recession. They have a mandate keeping their exposure neutral. So based on positioning, and that half of their positions expire, they might take a different look, right, at overall portfolio, and that's where you can have that cascading effect. All right. So what can you do at on Tradespoon? What are some of the services we offer? So we offer different services, right? One is half of the services are geared toward ability for you to see my trades, right? And participate in live trading room, whether Scott or I are leading them, and you can see all of my orders in position and follow them real time. So elite service is where you get access to morning bell and closing bell, and every day, right, there are trades, right? Today, this was from Active Trader, right? Caterpillar. So you go to Active Trader, you have Visa, Nucor, Lowe's. There was another one, Caterpillar. So, I traded Caterpillar, right? Or you could trade one of these stocks. But if you sign up for Active Trader, right, or weekly trader or monthly trader, you have to decide at which point do you buy Visa, Nucor. We'll give you suggestions, right? We'll give you cues, right? But you have to make a decision, right? In Active Trader, we're looking for 1% target gain, 1% stop loss. And I always use dollar cost average, right? I split the trades into two because, yesterday interest rates was up 5%, today interest rates is down 5%. I mean, you can, on day-to-day basis, you can't really know which way the market is going to go. So it makes sense to split your trade position into at least two, right? So that's the entry one, entry two, and then target gain 1% up, 1% down. A lot of time people will ask me, well, Visa is at 276, it's never entered 277, I mean, right now 277, but let's say it's never got to this point. And then I have support tickets, people say, well, it says 277.05, what if it's 277.41? Should I still enter into the trade? What that means is that you probably don't have a trading plan, right? The idea of Active Trader is idea generation and suggested entry and exit prices. But if you're 10 cents away and you still don't know what to, should you enter, should you not, or you don't know the difference between buy to open and buy to close, then this is probably not the service for you, right? I would rather you, be honest with everybody and just kind of tell you up front that, listen, to use signals or idea generation, doesn't matter what service, Tradespoon, Yellow Tunnel, any other places or on CNBC, when you listen to somebody say, I'm long Microsoft, and the question becomes, at what point do you enter, at what point do you exit? And if you don't know what the answer is, you haven't traded long enough, you don't have your trading plan, right? You don't have that confidence, right, as a trader, then I would say don't start with active traders, start with the lead circle, because I will tell you when I enter and when I exit, right? You get SMS message, right? You're following somebody who's been doing this for 20 years, right? That is much better experience and much better learning, right? And then you can become successful trader if you just follow these trades, right? And I'll tell you exactly when I enter, when I exit. You might adjust, I'm looking for maybe 0.5% profit, maybe you look for 1% profit. You can adjust these entry and exit points, but at least you know what I do, right? Same thing if you're doing earnings strategy, right? Apple, right? I sold diagonal call spread, diagonal put spread. So I try to do both, right? Centered around earnings, right? And same thing, I'm using implied volatility and historical volatility, and I look at these entry and exit. And if you saw yesterday at the closing bell, we were talking about, that Apple is open for positive or negative surprise, not a lot of premium in the option. The same thing was Meta, right? I only bought puts. I should have bought calls, long calls too, would have, probably quadrupled my money today. But the fact remains that you have this valuable information during live trading room that can help you decide which strike prices to select or where the support and resistance levels are, and you will see, benefit of that analysis. So I do propose to sign up for Elite Circle. You can follow my trades, enter your phone number, click and submit. Don't forget that. A lot of people say, well, we're not getting text messages. Well, you have to go SMS alerts, click on this link, enter your phone number, and click on submit. Then you'll get them. Otherwise, we don't know your phone number. We don't know if you want these SMS messages, and you're not going to get them. But that's where you sign up, SMS alerts. You have morning bell, you have closing bell, and the most important, I know most people don't have time to listen to me, when the market opens, right? So that's fine, but that doesn't mean you should not watch the recordings, right? That doesn't give you like a get out of jail card where you don't have to watch the recordings. My belief, if you want to be successful in trading, right, you cannot just follow signals, right? Signals are tools. You have to follow somebody who's been using these signals for a long period of time, has confidence, and you can learn how they're using signals. Signals on their own is just tools, right? If somebody says, okay, here's the car, you never drove a car, go drive it, this is how you use it. I mean, you're not going to get very far, right? You have to take courses, you have to learn the rules of driving, then you have to, right? My 16-year-old daughter, she just got her permit. So every week she spends 2 days out of the week learning all the rules, green light, yellow light, yield, how much distance to keep between the cars. So, she's spending time, and now, before she starts driving, she actually needs to take driving classes, right? Trading is no different that you learn in the car, right? I mean, I can give you lots of tools, I can give you lots of signals, but if you don't know what to do with them, then that's a problem, right? So we do have one-on-one coaching. I mean, that is financial commitment, right? So I encourage you to try one-on-one coaching. If you kind of learn on your own type of thing, right? If you learn how to drive your car, just on your own, that's fine too, right? Most likely you had some difficulties on its way, but you learn, right? It's not a rocket science, you can do it. Then I encourage you to watch the recordings, right? At least watch somebody else drive the car, and then, you can probably pick it up yourself, right? So any learning experience, whether you're driving or whether you're skiing, can you learn how to ski? I learned how to ski myself, right? I never had a coach, never watched anybody. I mean, I almost broke my leg a couple of times, but I survived, and I love skiing. And now that I have some discretionary, money, okay, then I'm hiring a coach, which is fine as long as you understand the odds of success and the timing it takes you to get to a certain place. Both strategies will work. Some people are self-starters, self-learners. Some people need a little guidance. So Elite Circle, right? We do have a lot of trades, both stock and options. Some people just want stock, then it's a robo-investor. Some people just want options, then it's premium portfolio. right? You can just follow my trades, that's shadow trader, or you can just follow my option spreads, that's spread trader, right? But all of these are just my portfolios, and you have the same exposure, right? You can see orders, you can see positions, you get emails, you get SMS messages, and those are the services. I briefly mentioned Stock Forecast Toolbox. Right, that's the model we developed. I mean, it's very helpful, right? Today basically says trend is actually turning positive. We were flat for a while. Now it's turning bullish, right? 492 model basically says, you know what? I mean, we can get to 500 in the next, by the February expiration. Totally agree with the model, right? Unless there's some kind of negative catalyst, the path of least resistance is to hit 500, right? So it's a great tool, right? You can't really drive a car unless you have, speedometer, right? Or unless you have a map, right? You're not going to go too far. So this is your map that shows you which direction we're going and what to expect in the next 10 days or what to expect in the next 6 months in terms of prediction. We have seasonality charts, screeners, right? Those are other tools that seasonality is important, right? It's not seasonality and dealer flow. Basically, seasonality is just, there is a cause and there is an effect, right? So the cause is dealer flows, right? That's why you have seasonality effect, right? People say sell in May and go away, right? Or January, February, usually the months where you could have pullbacks. September and October are the worst months, for the market. Why? Is it because the moon and goes in certain positions, right? And the gravitational forces are changing, right? And people just feel a little different. Or is there some kind of underlying currents, right? So the underlying currents, it's basically a dealer position, right? And maybe this doesn't show you every position of everybody, but it gives you a lot of exposure and positioning. And you will see that during these months, January, February, you could have big pullbacks, right? We do show you seasonality, right? You can see usually January, February is kind of, could be volatile. If by end of February we don't have a pullback, usually March, April, May is very strong, right? And with immaculate disinflation and soft landing, you could have a pretty strong rally, in March, April, May, from whatever level we're gonna reach. Any questions on seasonality, screeners, active trader, weekly trader? Active trader, you also can see not only, if you're not comfortable trading Visa using stock, you can turn around and basically, use options. But the levels, if you're using options are derivative of stocks. So if you want to go long stock, then at the same time you buy a call and you go long. If you feel like Visa is reversing and selling, you want to sell the stock, well, that's the same time you sell option, right? You can't have, where you think option is going to go higher, stock is going to go lower. That usually doesn't work like that, right? They're tied at the hip. Any questions? 10, 12, let's see. What else do we want to talk about? Yeah, pay attention to yield, right? This big revert, it's oversold, right? It reached that bottom. So any positive news, but it looks like this uptrend is definitely broken, right? That's one observation. It's unable to break to this 4.30 level, which goes back to September of last year. So, as yield gets overbought, it's probably going to trade in the range, right? So yield, as we're approaching 420, 430, maybe this is the time to go along the market, right? Because that correlation kind of still is intact, at least today, right? People are selling TLT and they're buying QQQ, which is, well, this is a new relationship, right? Sorry, this is not new, right? In the past 2 years, it was vice versa, right? Yield goes higher, QQQ goes lower. And since the beginning of the year, the relationship has been broken, right? It's kind of historical correlation, right? People are selling bonds today, they're buying QQQ. Yesterday, they were selling QQQ, they were buying bonds. What does it tell you? that nobody cares about the stock market, not nobody, but the stock market participants do not care about the inflation anymore. They care about probability of recession, right? And when the probability of recession goes up, they're gonna buy bonds and sell stocks. And when probability of inflation goes, recession goes down, they're gonna, like today, they're buying technology and selling their bond positions. How does gold and silver look? They don't look good, right? It's a dollar, right? Most people are bearish on the dollar, including myself. But, doesn't matter what we think, what the data shows you. So you do have, in January, you have a strong move to the up in the dollar that's pushing the silver. We did have a reversal, but it's pushing the silver down, right? I personally think dollar is overbought. Majority of the people said 2 and 1. So if you believe in 2 and 1, dollar has to pull back, right? For equity, if the dollar is going to continue going higher, right, and this is long-term prediction, right? Right, it's facing this overhead resistance. So as long as we're below this line or below this downtrend in dollar, silver should do fine, and gold should at some point make all-time highs, right, and break through all-time highs. But at least in the months of January, it's week after week, dollar is stronger, right, and QQQ is stronger. At some point, this correlation will be broken, right? I think equity is the winner, at least until February, middle of February or towards the end of the February. I think that at some point dollar has to pull back, right? It's extremely overbought at this point. So once it pulls back, and like yesterday, right, when dollar pulled back, you had a big rally in GDX, right? So yesterday yields drop, dollar drop, everybody is, Fed is winning, and GDX is up 4%, and today it's down 4%, right? So give up all the gains yesterday and some more, because again, higher for longer theme. So if you believe equity market is going to stay at these levels, go higher, go a little lower, GDX is oversold, dollar is overbought, they should revert to its mean. If we have any dislocations or any liquidity issues, or another regional bank is going to go under, silver and gold should go up, right? But if you have this, kind of divergence, I don't know how long this divergence stay, where dollar continues to go higher and people are buying Nvidia, well, then, silver is gonna. The good news is that it's been weeks and it's not going lower, right? Whether it's GDX, right, this uptrend is intact, or whether it's silver. Right, we're not making new lows. So that's a win for the bulls. That means it's a bottoming process, violent bottoming process, but at some point, I believe silver should at least get back to this trend line. Genevieve, yeah, paper trading system. I mean, Tradier has it, right? This platform has it. You also have it on Thinkorswim, but they all work the same way. You're freezing. Today is Groundhog Day. All right, happy Groundhog Day. What is the seasonality for the dollar and gold? Let's see. Dollar and gold. We don't have. What's this? Silver. So silver for seasonality, usually you do have a drop in January, right? All the way to maybe January 12th, and then you do have a rally. Right now, correlation is 26%. So it's a little bit off, but it did start rallying. So from seasonality point of view, silver should go higher. That means dollar should go lower. Seasonality doesn't mean it will happen. Right? It just gives you, again, odds of certain thing happening. Gold, same thing. Yeah. So usually gold February, March, going into the end of February, you should have a long rally, but right now correlation is broken. Right now correlation is broken. So hopefully it's just a delay, right? And then this February movement in gold and silver will start, right? That's the green line. Seasonality is a green line. Red and blue is what actually happened. Thoughts on crude oil, right? USO is the ETF. I don't really follow it. Crude oil. I mean, obviously, if you set 1 or 2 and market is going to 505, then why is crude oil not going to 100? So, right. So everybody who believes in scenario 1 or 2, we're making all-time highs, soft landing. This is one chart you don't like to talk about. Right, you don't want to talk about this because all it shows you that demand is faltering, whether it's China, Europe, or United States, right? So this looks like a very bearish chart, right? I mean, it doesn't get any more bearish than this, right? Because you do get this descending triangle, and usually what happens with descending triangle, right? 70% of the time, 75% of the time, you have a break to the downside. So if we do have any signs of recession or demand continues to deteriorate, at some point, this descending triangle will be broken. 30% of the time, it gets broken to the upside. If there is a soft landing, if there is immaculate disinflation and economy is recovered in China, United States, then we'll break to the upside. I said 3, so I think crude oil is going lower. If you said 1, well, the crude oil is going higher, right? So if you want to know my opinion, I'm bearish on the market. I think the recession will occur, at least some kind of a recession. We're not going to have a 1995 scenario. So then the crude oil will go lower. But if you don't have an opinion and you say, Vlad, it doesn't really matter, trade what you see, not what you think, right? That's kind of my new motto for the 24. Trade what you see and not what you think. Well, what I see is descending triangle, and I don't like descending triangle, right? If you want to go long, you want a breakout on above average volume, right? If you see a breakout above average volume, you can say, Vlad, you have no idea what you're talking about, I'm long. But you want to wait for this thrust higher on above average volume, right? Because ExxonMobil announced earnings today. And, they missed, I mean, it's kind of flat right now, but they missed on the revenue, right? So this is not a good, strong price pattern for ExxonMobil. Strong. Apple is recovering. Yeah, Apple was down 3%, but Apple goes where the market goes, or vice versa, right? It's not like Apple is going to be down for a very long time and QQQ is going to be up. So because Apple is in a lot of ETFs, it's got to kind of push in, but not a good price pattern, right? We revisited basically in aftermarket even lower. So we already made new lows, January lows again, right? We're just sitting on this very key support going back to December of 21, right? We basically revisited the top end of December of 21. If that top is taken out, right, then in this uptrend is broken, which it appears short term, well, you don't really have the bottom after that, right? Well, sorry, next level is 170. So you can, a couple more weeks where we make new lows, and you're gonna see Apple at 170. Any other questions? Okay, you guys are awesome. I appreciate your time. Thank you very much for spending an hour with me, and I will see you at the closing bell or hopefully Monday morning. Thank you.